Wealthy investors in more than 30 states are finding a workaround to escape that state and local tax deduction cap, and it could cost the government billions in revenue. Robert Frank is here with more. Robert?
So this is a creation that the states started to do in 2018, where they basically had looked, let's create this pass-through entity tax, where you basically transfer the tax obligations of the individual onto the company. And companies, by the way, are not subject to a SALT cap. So what you do is the entity pays the tax, entity gets the full deduction from the federal government, then passes that deduction onto the individual. So basically, if you own a pass-through, an LLC, an S-corp, or a partnership, you don't have any cap on your state and local tax deductions if it's done through a pass-through. And there are now 30 states and growing. New York City became the first municipality this month to do it, so you can write off your state and city taxes.
Oh, so they're now blessing this move. Let's not joke ourselves. They are blessing this move by allowing more people to do this.
The IRS, in the waning days of the Trump administration, said this is okay. Every other workaround, all the charities they tried, was not. But the IRS explicitly blessed this one, and that's why all these states are rushing in. We now have California and New York together have about $40 billion already in income.
This was in the Trump administration. May I ask whether the Trump administration, principles of the Trump administration might have benefited from this?
They may have, but what's interesting is the benefits are much wider than anyone expected. $40 billion in income so far in New York and California. There's an estimate by a professor at NYU that $50 billion of income, of revenue, will be lost at the federal level by the time the SALT cap expires in 2025. So it's a benefit that basically benefits hedge funds, private equity guys, business owners. So those who make more than $1 million are the ones that this benefits the most. And it's very unfair. Look, most of us are subject to the SALT cap. But if you own a pass-through and get your income
and you get your income through it, you got to get your income paid to you through that S corp or the LLC. Now, it's a separate thing, real estate tax, right? I mean, there's an amount that you can deduct of.
That's right. So one of the beauties of this is that you can not only deduct all of your business income that you get through your pass-through, so that's most of your income, but you can add on to that up to $10,000 in property taxes. So you get the benefit of no cap on your income, plus you can keep up to $10,000 in other income or property taxes. So there's a plus for those who are lucky enough to own a pass-through.
Yes, as we all roll our eyes and go, oh, what a shock.
Yeah.
What was this original pay for? Was this part of the Tax Cut and Jobs Act? We remember this came into creation to pay for something which now it will pay less of if fewer people are having to pay this tax.
Right. So the SALT cap was one of the ways that we paid for that corporate tax cut. Now, like many other individual components of the tax plan in 2017, this will expire in 2025. So the question is, what will happen just broadly to the cap? Depends on who's going to be in charge, right? Do we have a divided Congress? But there are all sorts of scenarios that are possible depending on who's in charge of the White House and Congress, because all these components of the individual side of the tax plan, which is the lower rate, the 20% deduction on businesses, all the individual components, including SALT, will expire. So we could feasibly go back to the old no cap in 2026.
Very interesting.
No cap sounds like something the kids say these days.
Yeah.
Robert, thanks very much. We appreciate
Thank you.
it. Robert Frank.